This is the fastest sell-off in history. The markets are in free fall. The Fed injected the same amount of liquidity in a week as it did during the entire QE2. Despite all of this, it hasn't been able to push stocks higher. They will probably buy corporate debt, and if that won't suffice, they'll buy stocks. You came here for the truth, so let me unveil that for you. We are going to talk about the worst sell-off ever. I'm going to show you the markets. I'm going to show you what happened with the Fed. I'm going to give you updates on oil and everything that you need to know right now. This is another ridiculously jam-packed episode. I might have to break it in two parts. We'll see how it goes. Let's start with the markets. Here we have the Dow Jones down 913 points on the day. Well, it didn't hit that 1,000 mark. We've been seeing a lot of those. It was down, believe it or not, 4.5%. Suddenly, 900 points is more significant than it was previously. The VIX, actually, if you can believe it, 66. While the markets haven't been doing so well, the VIX index has been elevated, but not necessarily responding in the same way that the markets have. The S&P 500 is sitting at 2,300 and the Nasdaq is under 7,000, and it has performed better than the other indexes. Bear market comparable to 1929 and 1987. The blue line, that's the S&P 500 right now, going from March 2019 up until the present. You're seeing how it was. It was a year of gains essentially, and then things turned around. It was a massive decline, at least up until this point. Anything could change. Practically in a straight line downward. You compare that to 1987 as well as 1929, and believe it or not, through this time frame that we've seen so far, it's actually worse right now. We're living through it. We are seeing history being made. This is a chart that shows you all of the previous bear markets. Those are the gray lines, and the red line is the current market. Now understand, we are comparing this over the last 100 years, and this is the worst that we've seen this far. It could turn around tomorrow, who knows? I'm just showing you right now up until this point, the most exaggerated the US has ever seen. People need to understand how important this information is. Look at the price of oil right here. It's at $22 a barrel. Brent crude at $29 a barrel. And imagine if this persists for a period of time, it goes on another 3 months, another 6 months, I do believe that oil will fall significantly from at this point. Many have suggested that the deflation Mike Maloney talked about, $10 oil, being a very realistic possibility. The upcoming job losses will be unlike anything the US has ever seen. The crisis we're dealing with now is likely to result in layoffs on a scale that the US has never seen before. Forecasts for the month range from 500,000 to 5 million. As it mentions in the last point here, they're probably going to delay the numbers. That's how bad they are, because they know it's just going to send the markets down lower, and then the jobs might be affected by that. You know something is seriously going wrong when they're trying to cover it all up. The US economy is deteriorating. Look at what's happening all around the United States, and then take a wider view around the world. Same situation. The entire world right now is in a recession. They haven't been able to admit that yet because time has to pass and they have to look back at the data, but we know where we're at. Just 2 months ago, this was the greatest thing ever. No worries. We're all good. Markets are heading higher in the US. Ray Dalio said cash is trash, and now the complete opposite is true. I'm going to show you a chart in a second here, but this is what you call a black swan event. Nobody ever predicted it could happen. Nobody ever priced that into their analysis, and suddenly it takes everybody off their feet. U.S. jobless claims may reach 2.25 million, Goldman Sachs economist estimates. There's no way to determine this. These estimates really aren't very good. The range is so wide and so on, but just know that it's going to be massive. Goldman Sachs has a devastating revision for its GDP growth predictions. The bank projected a 24% drop in the US GDP in the second quarter. They say, of course, it will rebound afterwards, but it will leave the GDP down 3.8% at the end of the year. I actually agree with the fact that once things start to slow down in terms of the issue that's going on right now, we could definitely see things pick up again in the economy. Certainly very possible, very likely. The question is, what happens? How much damage is done in the meantime? To try and put dates on it is so inconsistent with reality and history. It just doesn't work out. But this is what they do. They're predicting 24% drop. Here's the chart that corresponds to that data. Goldman Sachs provides it. Essentially what we have is first quarter is down, second quarter is much, much worse, and then we have it ramp up in the third quarter, and then it goes back to growth that they can never get to regardless. I don't know why they would ever suggest this into next year when they can barely struggle to get 2%. Somehow they're going to get 4%, 5%. It's very unrealistic. Regardless, this is what they're showing us here. I got a lot of data to cover related to the Federal Reserve. Check this out. The Federal Reserve is expanding its asset purchases to include municipal bonds. They're buying everything. The Federal Reserve is buying everything all along the way. They haven't got to the corporate bonds yet, and they haven't got to stocks. They're going to go in that direction. Like I said in the intro, probably going to go to corporate debt next. If that's not sufficient, they'll go towards stocks. We're looking at the Federal Reserve's balance sheet directly from the federalreserve.gov. It has hit $4.7 trillion. That means that they printed $400 billion in a matter of 1 week. This is the most extreme level I have personally ever seen. It's ramping up in this hockey stick pattern. It's so aggressive, and yet what has happened to the markets? They've gone in the complete opposite direction. They're buying municipal bonds. They're bailing out every institution backdoor, JP Morgan being one of them. I got a huge video. If I can do it, explain it properly, exactly what happened. The repo crisis has now been confirmed. Bloomberg has a lot of data on it. It was a bailout for the hedge funds, for JP Morgan. Money is absolutely needed, and that's why this crisis is happening now. Coordinated central bank action to further enhance the provision of US dollar liquidity coming directly from the Federal Reserve's website. The central banks are getting together again, making sure that there is liquidity in between these central banks. They did this many times before, of course. It didn't have a positive impact last time, but they're doing it again. They say they are just loans. This is not as if the Federal Reserve is printing up a bunch of money and giving it to the other central banks. They are not transparent with their data. We don't know what happens all along the way. All we can do is take what they give us and just know that there is serious weakness in the financial system, that despite all of the money printing, all of these different central banks are doing, all the interventions on every single level, it's still not enough. Fed purchases of treasuries and mortgage-backed securities. If you can't see the font here, we're looking at it September, October, November, all the way up to March. And March, it just goes wild. It's insane, the growth that we've seen. I showed you that chart. There wasn't much happening when you look at it for several weeks in a row, and then out of nowhere, it spikes up. Fed Treasury mortgage-backed securities purchases since the restart of QE. This has been ramping up, showing you from March 13th to March 20th. It's growing significantly. I will continue to bring you the data, give you what you need to know, but I think you can follow the trend line here. It's going to get worse and worse. Look at this, total Fed purchases back in March 2009, the bottom, the worst it got, $162 billion. This week right now, $300 billion. It's worse than that time frame. What does that tell you about the current situation? That's the question I have, not just for my subscribers. Of course, I know you know what's going on, but those in the financial industry trying to make it seem like there isn't some underlying problems that are really being stressed right now. On the way up in the previous bull market, there were certain statistics that when you put the two charts over top, you find that they get out of whack and then they come back together during a bear market. This happened to be one of them. We're looking at the corporate profits versus the S&P. Yeah, things were out of whack and a lot of people said, well, that's just the way it is now. Things are different. You got tech stocks and so on. But let's be realistic about this. We are seeing the same pattern repeat from the last two instances, particularly similar to what we saw during the 2000 crash. Unjustified prices coming back down to reality. Total market cap, the GDP ratio, we are watching this go down in a straight line. It's nowhere near where it had been historically. Despite the intensity of this market crash, we are still at the peak of the housing bubble. That's how overvalued we became. This is one ratio definitely to follow. It doesn't necessarily mean it's going to head any lower. GDP is heading down all over the place. It all depends on the ratio itself. Either way, things are out of whack right now. This shows you the US total stock market capitalization. It peaked out at about $90 trillion. It's now at 62. Where has all that money gone? I'll show you that in just a second. Where do you think it is? An extraordinary week of $100 billion bond fund outflows. It's so off the charts. Take a look at it on the left-hand side. It makes you look twice. You think to yourself, what's that line on the right? And then you realize that's actually one of the bars. Same situation on the right-hand side, led by a record of $55 billion capitulation from investment-grade bond funds. If you see how it was from 2019 into 2020, there was more and more money moving in, and suddenly a 180-degree spin. Left-hand side, a record $11 billion out of municipal bond funds. And guess what? Federal Reserve is bailing that out, right? Let's see what happens in this case. I'll give you updates as I get them. On the right-hand side, tech funds remain the last hiding place for deflation bulls. Weekly tech equity fund flows have been massive in this case here, but cash is where a lot of the money is going right now today. People are worried. They want liquidity. They need to get their money out and simply wait. That's what a lot of these investment companies have been doing. That's what the data has been showing. And of course, everybody's favorite, 7 shares of Amazon. Well, anyway, that's all for this video. If you found it informative, hit that thumbs up button. When you do, you're supporting me. Thank you very much. I create content on Instagram and Twitter every single day. You gotta follow me on there as well if you want to get all the details and get it faster than these videos that I make here. Check me out at The Money GPS. If you want to learn how to sell stuff online, you don't want to pay $1,000, $2,000 for one of those courses, I have a free e-course, theamazongps.com. If you want to understand the financial system from its core, you need to understand what's in these two books. Check them out at the link in the description. If you want the audiobook instead, themoneyGPS.com. If you are interested in the solutions, if you want to know, what do I do? Well, there's a set of videos right here that you definitely have to watch. Click on it and I'll see you there.